Welcome back to the Algobot channel, where we take apart automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm Algobot, your guide, and in today's lesson we're studying a price action strategy named Origin Zone Retest. This expert advisor combines the idea of supply and demand zones with market momentum, using nothing more than raw candlesticks and the average true range indicator. Over the next few minutes, you'll learn how it detects a strong impulse candle, how it marks the zone that candle left behind, and how it waits patiently for price to return to that zone before it ever considers a trade. Let's dive in. So what exactly does the Origin Zone Retest Expert Advisor do? At its heart, this is a supply and demand strategy with a momentum filter, and it works on a single time frame using price action alone. It can be studied across many markets, from foreign exchange pairs to indices and metals, on whatever chart time frame you prefer to analyze. The core idea is simple to describe. When a market makes a sharp, decisive move, it usually departs from a specific area on the chart. The strategy calls that starting area the origin. A strong bullish impulse candle leaves behind a fresh demand origin below price, while a strong bearish impulse candle leaves behind a fresh supply origin above price. The theory being explored here is that these origin areas often see a reaction when price revisits them for the first time. The only indicator involved is the average true range, or ATR. The strategy uses ATR to judge whether a candle is genuinely strong relative to recent volatility, and it also uses ATR to size the zone, the stop, and the profit target. There are no oscillators and no moving averages here, just candles and volatility. Who might this style of strategy suit from an educational standpoint? It's designed around structure and patience rather than constant activity. It keeps only one fresh zone per side at a time, and it waits for a clear retest before doing anything. That naturally limits how often it acts. Remember, this video is a study of how the logic is built, not a recommendation to trade and not financial advice. All trading carries risk, and losing trades are a completely normal part of the process. Our goal today is simply to understand the mechanics. Let's walk through the exact logic, step by step. Everything happens on the close of each completed candle, so the strategy never reacts to an unfinished bar. First, the strategy looks for an impulse candle. For a candle to qualify, its body must be at least 1.2 times the current ATR, and that body must also fill at least 55% of the candle's full range. Those two conditions together confirm a move that is both large and decisive, rather than a wide bar stuffed with long wicks. When a bullish impulse qualifies, the strategy records a demand origin. That zone runs from the low of the candle up to its open, and if the area is too thin, it is widened to at least half of the ATR, so there is something meaningful to retest. A bearish impulse does the mirror image, stamping a supply origin from the candle's open up to its high. Only the single freshest zone on each side is kept at any moment. A zone stays valid for up to 30 bars, which is the zone lookback setting. It is discarded if price closes straight through its far edge, and it is used only once. Now for the entry. For a long, the strategy waits for price to trade back into the demand origin and then close with a bullish candle whose body is at least 30% of its range. When that confirmation appears, the expert advisor signals a buy at the current market price. The stop loss is placed one ATR multiple below the far edge of the zone, and the distance from entry to that stop becomes the defined risk. The take profit is set at 2 times that risk, reflecting the default reward to risk of 2 to 1. A short works in reverse, using a bearish confirmation candle inside a supply origin. There is also a small safeguard. The measured risk must be at least 15% of ATR, which screens out cramped, low-range setups where the stop would sit almost on top of the entry. Finally, once an open trade has traveled one full unit of risk in its favor, the strategy lifts the stop up to the entry price, aiming to protect the position from that point on. Every trade, therefore, carries a predefined stop and a predefined target from the very moment it opens. Let's read through the actual MQL5 code as it appears in MetaEditor. At the top are the input parameters you can adjust. ImpulseAtrMult, defaulting to 1.2. Sets how large an impulse body must be relative to ATR. BodyRatio, at 0.55, sets how much of the candle's range that body must fill. Zone lookback holds a zone valid for 30 bars, ATR period is 14, and the SL ATR multiple of 1 places the stop 1 ATR beyond the zone's far edge. Reward risk of 2 sets the target size, and lots fixes the trade volume. Now look at the 2 signal blocks on screen. The long block checks that a demand zone is active, that the confirming candle is bullish, that its body is at least 30% of its range, and that price is actually traded down into the zone. When all of that is true, it reads the ask price, places the stop 1 ATR below the demand low, measures the risk, and calls trade.buy with that stop and a take profit at the reward risk multiple above entry. The short block is the exact mirror. It checks for an active supply zone, a bearish confirming candle, and price trading up into the zone. It then reads the bid price, sets the stop 1 ATR above the supply high, and calls trade.sell with the matching stop and a take profit below entry. Both sides share the same structure, just flipped in direction. Now let's bring the whole strategy to life on this illustration. Watch the candles build from left to right, and I'll narrate both a long trade and a short trade in sequence. On the far left, price is drifting quietly with small candles. There's no strong move yet, so the strategy simply waits. Then a large bullish candle appears. Its body is big compared with recent volatility, and it fills most of its own range, so this qualifies as a bullish impulse. The moment it closes, the strategy stamps a fresh demand origin at the base of that candle. You can see it shaded in green and labeled demand origin. That's the area price departed from on its way up. Over the next couple of candles, price pushes a little higher, but momentum fades. Then the market begins to pull back, candle by candle, drifting down toward the green zone. Notice that the strategy isn't chasing this move. It is simply waiting to see whether price will return to the origin it remembered. Price now dips into the demand origin, and this is the important moment. The retest candle trades down into the green zone and then closes bullish, with a body large enough to count as genuine confirmation, at least 30% of its range. That satisfies every condition for a long, so the buy entry marker appears. The stop loss sits just below the far edge of the zone, 1 ATR multiple beneath it, and the distance from entry down to that stop defines the risk. The take profit target is placed at twice that distance, following the 2-to-1 reward to risk setting. From there, buyers step back in. Price lifts away from the zone over the next candles and eventually reaches the take profit target above. The long trade is complete, and the strategy is flat again, ready for the next setup. Now watch the other side of the coin. A large bearish candle drops sharply. Again, its body is big relative to volatility and fills most of its range, so it qualifies as a bearish impulse. As it closes, the strategy stamps a fresh supply origin near the top of that candle, shaded in red and labeled supply origin. That's the area price left behind on its way down. Price eases a little lower, and then the market rallies back up to retest the red zone. As before, the strategy patiently waits for confirmation rather than acting on the first touch. Price pushes up into the supply origin, and the retest candle closes bearish, with a body large enough to confirm the signal. That completes the short conditions, and the sell entry marker appears. The stop loss for this trade sits just above the far edge of the supply zone, again 1 ATR multiple away, and the take profit target is placed at twice the risk below the entry. Sellers then take control, and price slides down over the following candles until it reaches the lower take profit target. The short trade is complete. Notice what this illustration shows about the strategy's character. It doesn't try to catch every wiggle. It waits for a decisive impulse to define a zone. Then it waits again for price to come back and confirm before it acts. Each trade carries a structure-based stop just beyond the zone and an asymmetric target, and once a position has moved 1 full unit of risk in its favor, the stop is lifted to break even to help manage the trade. This is, of course, an idealized example. In live markets, price often ignores a zone entirely, retests can fail, and losing trades are a normal part of any approach. The illustration is here to make the logic clear, not to suggest that every setup will look this tidy. So there we have it, a complete walkthrough of the Origin Zone Retest Expert Advisor for MetaTrader 5. We covered how it defines an impulse candle using the average true range, how it marks a fresh demand or supply origin, how it waits for a confirming retest before signaling a long or a short, and how it manages each trade with a structure-based stop, a 2-to-1 target, and a move to break even. Everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Automated strategies can and do experience losing trades, so always study any approach carefully on your own before drawing conclusions. If you found this breakdown useful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.